there's too much silliness in the markets right now. At least that's a core to what Michael Burry says, because he says that we're seeing a repeat of conditions that led to the 2000 dot-com crash. Michael Burry, as you probably know, is the famous investor who got rich shorting the housing market before the 2008 crash. And now he feels that we're setting ourselves up for another stock market crash, kind of like we saw before the year 2000. And it all started with him tweeting this. He said that another feeling that I'm getting right now is free cash flow is totally on sale and is ignored while former momentum stocks are coming down, but not far enough. And darling, quote, better businesses still have a ways to fall. Value was about to take off for years despite more cash on the way. What that means is before the year 2000, when the dot-com bubble burst, you had all these internet companies that had risen to insane valuations before the year 2000. Essentially, if you were a company and you put the word .com at it, you could easily raise millions and millions of dollars no matter what you were doing. And before 2000, people were just throwing their money into .com companies because everybody said that these companies could never fail. And then came the year 2000, and that's when reality started to hit, and then the dot-com bubble bursted, and you saw these dot-com companies crash. Many of these companies went bankrupt. Some of them went down very low, including Amazon, which lost over 90% of its valuation. But you saw these companies get obliterated, and along with that came a recession, and along with that came an overall stock market crash. Good companies, what he calls value companies, were also hurt. These are companies that have a lot of cash, companies that have big profits. They were also hurt because of what was happening in the dot-com bubble. And so it kind of trickled down into other parts of the stock market and the economy. And he's saying that he's feeling the same way today. He's saying that we have a lot of tech companies, a lot of what he calls momentum companies that have grown to insane valuations in the last number of years. And now they're on their way down, but they have more down to go. And this is hurting all types of companies, not just those growth, techie, momentum companies. He follows up by saying that the difference between now and the year 2000 is the passive investing bubble that has inflated steadily over the last decade. All theaters are overcrowded, and the only way anyone can get out is by trampling each other, and still the door is only so big. I'm a fan of most passive investing, and passive investing is where you automatically invest a piece of your income anytime you get paid, and it automatically gets invested into a number of different ETFs or index funds. And I'm going to explain why he's saying that we're building a passive investing bubble in just a second. But then he followed up that tweet with this. Just remember, I was feeling greedy on the long side in 2000. In other words, there's a lot of opportunity ahead. Now, if you wanted to invest your money in the stock market and you wanted to invest your money into individual companies, what you would do is you would take your money and now you're going to start researching companies. Maybe you put some of this money into McDonald's. Maybe put some of this money into Coca-Cola. Maybe put some of this money into Amazon. And the whole idea is now you're going to be researching these companies. You're looking for good companies. And ideally, you're going to be keeping up with the companies, their earnings calls, their statements. That way you know that you're investing in good companies for the long term. But the problem is, you have some people, or a lot of people, that don't want to and don't know how to and are not interested in researching companies. They don't have the psychology to invest in individual companies, where now you got to be able to handle the swings up and down, and people want something safer where you can just invest your money into a fund and get exposure to a lot of companies. This is where passive investing became very popular. So now, instead of investing your money into these individual companies, what you can do is you can take your money and invest your money into an ETF or an index fund or any sort of really fund. And then this fund is going to then invest your money into a big basket of companies. Now, this might include something like McDonald's and Coca-Cola and Amazon, but then it's also going to invest in hundreds of other companies that you might have never heard of before. One of the most common ETFs to invest in is an ETF called SPY, which is a SPDR ETF. SPDR is the company which invests in the top 500 companies in the stock market. And so this is a way now for you to get exposure to the biggest 500 companies in America, essentially. And if you invest in this, you're going to get exposure to hundreds of different companies. Now, if we go onto the SPDR website, you're going to see the top 10 holdings for SPY. And you're going to see that these are companies you know: Apple, Microsoft, Amazon, Alphabet, Tesla, Alphabet Class C, Berkshire Hathaway, United Health Group, Johnson & Johnson, and ExxonMobil. But then if you dig a little bit deeper and you download their entire stock list, what you'll see is there might be some companies that you have no idea what they are. Like if we go to 498, you have Organon and Company, 499. Franklin Resources Inc., 500. Newell Brands Inc. Now, by itself, it might not necessarily be a bad thing, but it does have some implications that you want to be aware of. A stock price is determined by supply and demand. When you have more buyers for a stock, the price of the stock goes up. And so when you have a lot of money flowing into these ETFs or index funds, and these ETFs are investing into a basket of companies, well, now the companies that are in this basket, whether you know of them, like Amazon or Coca-Cola or McDonald's, or whether you haven't heard of them, these companies are getting more investment dollars there. And so now if you have a company that maybe isn't so good, or maybe isn't really well known, but it's in these ETFs, and now it's being bought up, well, now what could potentially happen is the valuation of these companies is going higher than where it should be, because you have a lot of dollars going into it that shouldn't be. Because now if you were individually doing the research, you might not throw your money into one of these random companies that you've never heard of before. But when you put it into an ETF, well, kind of a byproduct of that is that some of your money is going to be going into companies that you don't really need or care for, or you don't even know about, because it's just in that basket. Well, this causes the valuation of some companies to go higher than where it would be normally if you didn't have this, because people wouldn't be putting their money into here voluntarily, because they're going to put their money into the companies that they know and understand and that they researched. And this is where now Michael Burry and other people have been talking about this passive investing bubble that has been brewing for the last number of years, because of the number of people that have been investing their money passively into these funds, which are putting money into companies that shouldn't be getting the money, and that this ETF fund is not putting money into companies and making the valuations of some companies significantly higher than they would if these companies were not invested through these ETFs, if people directly invested into the companies, because now this passive investing is just putting money into companies without actually analyzing or researching the companies. And this has some consequences that you want to be aware about. Now, of course, we do cover all this stuff of what's happening in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, you need to do that. Market Briefs is a free way for you to stay up to date on what's happening in the stock market, the real estate market, the crypto market, inflation, and the global economy. My team every day is breaking down what's happening. That way you can be a smarter investor. That way you can make smarter decisions with your money. And the best part is it's completely free. So if you haven't already, be sure to join Market Briefs. I got the link to how you can do it down in the description below. In his tweet, Michael Burry says there's one way out. And what that means is eventually reality will hit where some of these companies in here will fail. And what that will do is it's going to cause the value of these funds to go down. And if the value of these funds then go down, you're going to have the investors who might not have the best psychology looking at their ETFs, looking at their funds saying, oh my God, the value of my investments has fallen so drastically. What do? I need to get out. It's a bad investment. I'm going to lose everything. So then they start selling, which then causes the value of more investments to go down, causing this negative spiral. And that will then overall hurt the value of the stock market. It will hurt the economy, because now we have pain in the economy coming ahead. We have companies that are struggling. And as companies struggle, eventually it's going to hit the stock market even more. He says pretty openly that our stock market has more pain ahead, that we're going to see more downward slides in the market. And that's going to cause some and more companies to get hurt, which will then trickle down into the funds being hurt. And that will then hurt people's portfolios, which will force people to sell, which then reinforces this negative cycle. And what he's saying is then that's going to cause this collapse or crash in the markets, which will then create a great buying opportunity for people. Now, passive investing, if you want my opinion, is a great tool for average people. If you're not interested in doing this type of research, passive investing is the way to go. But the key for passive investing to work, because passive investing is just a way for you to invest in a lot of companies without having to do the research of all of this. And yes, you're going to have swings in the market. It's not just passive investing. You have the same thing that happens here, where you're going to go through booms and busts. What passive investing does is it just brings more money into the markets. And when more money comes into the markets, that means you can have bigger booms and busts. So the key here, now as a passive investor, is to stay consistent even when the market goes down, to keep investing your money, because when you have the downturn, that creates more buying opportunity, and that's where you want to continue buying. So I like passively investing my money. It is one of the ways that I invest my money. I also do some of this, but this is where you got to understand that you're going to see pain ahead, but it also creates opportunity. Like Michael Burry says, Well, that being greedy when people are fearful, being greedy when things are bad is a great opportunity to start buying because that allows you to buy even more at a discounted price. And so if you're a passive investor, the key here is understanding that passive investing works when you invest for the long term. It doesn't work when you just invest for the short term and you start selling when you see the portfolio go down, because it's not just that these ETFs or index funds are going to go down. It's the whole companies, the stock market, the economy goes down, and the passive investments get hurt as a byproduct of that. But this is where you got to understand, again, I'm going to say this one more time, your goals. If you are a passive investor, the key to being a successful passive investor is you have to be investing for the long term, not the short term. And this is where knowing your goals is going to allow you to become wealthy, but it requires you to know what type of investments you want to be making.
Oh, don't worry. You can buy this TV with no money down with a 0% APR, and you can just pay it off in 12 months. You can keep that $600 in your pocket and you can invest it somewhere else so you can get a better return on your money. And now you can buy this $2,000 TV, pay it off in installments, and pay $0 in interest. What could be better than that?